that we're trying to make, and really the information that you need to really become a successful professional day trader. Just hang on 1 second. Just let me switch screens. Okay, now what I'm demonstrating here is price and an oscillator. Now, an oscillator, the formula, the four requirements in order for the oscillator to generate a line is the open of a candle, or the open of a formation, the close of a formation, the high, and the low. Now, I've seen a lot of software packages that use stochastic on Renko bricks. Stochastic does not work on a traditional Renko unless the Renko has a wick. Now, the point I wanted to make here is this, is that if you look here, you can see what appears to be, in retrospect, stochastic exactly predicting when price is going to fall and when price is going to rise. The problem is that if you do a year of market replay data, you will find that stochastic has absolutely no predictive value in determining the future direction of market movement. There are a set of buyers or a set of traders who, when the market becomes overbought, will continue to buy every time price breaks a new higher pivot. And then there are the buyers that are looking, or the traders that are looking for divergence. And we don't get divergence here. We get a lower high, not a higher high. And, well, let's see. Maybe we do. Yeah, price makes an equal high, and this is a lower high. And so what we have is divergence, and we have a fall. Now, the problem with trading an indicator that assimilates data from your trading chart, as I mentioned, is that it really doesn't have any future predictive value whatsoever. Price drives the oscillator. Oscillator doesn't drive the price. The same thing is true for the MACD. Now, it all looks great when the market's closed. That's the problem when you assess these indicators, is that price is driving the MACD. Now, the MACD crossover looks great on a static chart, but when you get this crossover in real time, what is the predictive value that the market is going to continue to rise? And that predictive value is essentially zero. If price rises, the crossover is successful. If price falls, then the crossover is not successful. The point is that at this inflection point, right here, when you're trading the right edge of the chart, can you use this to determine whether or not the market is going to rise or it's going to fall? And the answer to that is no, you cannot. Now, we've looked at MACD and we've looked at stochastic, driven by price from the trading chart that you were using, and we've looked at market replay data going back a couple of years, and it just doesn't have any predictive value. Now, what we're saying is what almost everyone says, and that is that indicators are lagging. they lag the market. They don't lead the market. And people who have that philosophy are 100% correct. These indicators do not have any predictive value in determining the future of market movement. Now let's take a look at a more sophisticated indicator. This is market profile. Now market profile has a value area high, a value area low, and a point of control. This is where the greatest price at volume crosses, and this is within the bell-shaped curve where approximately 70% of volume at price crosses. So the market tends to want to stay within these two boundaries, and it doesn't really want to move above the value area high or below the value area low. Now, this is a really, really nice indicator that we use. We rely on heavily when we day trade in the right line trading day trading room. But what we do is we have set this to a proprietary look back period. So although market profile is being driven by price on your trading chart, it also is assimilating data from days back. So with market profile, we're looking at a look back instead of a look forward. And it does have nice predictive value in determining whether or not price is going to break or price is going to bounce. We always make the assessment or make the assumption that price is going to hold. Now what we're trying to do is we're trying to trade with precision. Now let's take off all the indicators and let's just go to a completely different philosophy. And this is the philosophy of right line. I'll take this off. Now, no matter what system you trade, no matter what kind of bars you trade, including Renko, no matter what time frames you trade, this is one of the indicators that we use, which is going to be extremely beneficial to helping you trade. And the first one I'm going to show you is bias. Now, bias is an indicator that is not affected by any price movement on your trading chart. What it does is it assimilates market direction on two higher time frames. In this particular case, we're trading an 8-range chart, so we make the two higher time frames the next higher fibs. The next fib after 8 is 13, and the next fib after 13 is 21. If you were trading a 377 tick, your next highest fib on the tick chart would be your next highest time frame, and the next fib after that would be your third highest time frame. If you're trading time, it would be easy. You'd have a 1 minute, you'd have a 3 minute, and you'd have a 9 minute. Now the indicator automatically does that assessment for you. So when you change the reference point or the time on your trading chart, the higher time frames will automatically change. Now what you have is the indicator driving price. Now green is our strongest up color. And remember that the green background here is not affected by price on the chart. The green is predicting that the price is going to rise. And it does. The blue has another meaning. It's a little bit of a weaker up bias, but it's also predicting that price is going to move higher on your trading chart. And this is also a very strong predictor of price movement to the upside. Now, you have to incorporate this with market structure, a 50, a 15. But in terms of predictive value, this has huge predictive value as to what the market is going to do into the future and is totally unchanged by any price on the trading chart. You can see right here, get an enormous move down. Now, the enormous move down doesn't create the pink color. The pink color is what predicts that price is going to fall, because two higher time frames are now in free fall on the pink. Now, what the background bias does is do two things. It looks, one, at the direction of the 50-day SMA and the direction of the 15-day, and it's our proprietary moving average. And it makes an assessment of that. And what it also does is it looks at support and resistance. Now, when you have this darkest pink, you have the 15 and the 50 heading to the downside, and the 15 has crossed our 50 to the downside as well, and all support to the downside is broken. And that's all indicated by this dark pink. Now, you can make the same assessment by looking at two higher time frames, but it's cumbersome, it's difficult, looking at support and resistance, looking at the direction of moving averages at support and resistance on two higher time frames is tough. This does it all for you. Now, this color, the 15 and the 50 are also down. Price has broken all support to the downside, but the 15 has not yet crossed the 50. It's slightly weaker. And here, you don't have a trending 15, but price is, again, broken all support to the downside. And you have the same thing to the upside, right here. Here, the 50 and the 15 are moving to the upside. Price has broken all resistance to the upside. And this is the strongest predictor of price on your trading chart moving up. It's this green background. And it is, again, not affected by any price on your trading chart. Once your two higher time frames swing that 50 to the upside, the 15 to the upside, and break all resistance to the upside, and background bias turns green, you are looking for a long trade. And once everything is broken to the downside, you're looking for a short trade. Now, it does two things. It not only predicts direction, it also censors you're taking a trade in the wrong direction, because it's very counterproductive to counter trend trade. Now, here, whoops, wrong indicator. Here, the prediction based on the higher time frames, not assimilating any data from your trading chart, tells you that the market is going to fall right here. But what this also tells you is don't take a long trade. Now let's say I'm going to put in here, I'm going to put one indicator in here to help us out. That's going to be our 50-day. To show you how helpful this is when we trade. Now there's our 50. Now, the only thing that we want to do is potentially take a retracement so that we're able to go short again. Take a retracement so that we can go short again. Wait for a retracement so we can go short again. But we are not taking any long trades with this color. So it helps us in two ways. It tells us that there's a very high probability that the market is going to fall, and it also tells us don't take a long trade here because you're more than likely going to get run over on the trade. Same thing with the upside right here. This tells you you may want to take a retracement to go long, consolidation, go long, retracement, go long, retracement, go long. But the one thing that you do not want to do, as long as the background bias is green, is even think of taking a short. And you can see on your trading chart that the 50 is heading up strong. And it almost always is. And this is what we look for, and this is the kind of setup that provides you with precision and entries that give you a predictive value greater than 85%, and it's multi-time frame alignment. Your trading chart is up, and your chart on two higher time frames are up. Now, if I put in really quickly here, this is our modified 15. It's a proprietary. Find it here. I just want to make it thicker. I'll make it a 4. It's kind of thick. Now what we're looking for is we want to take trades right off of support. Let's take this off. Take this off. What we do is we get a move up, retracement. We're long one tick above. And up we go. Then we only take trades when the 15 and the 50 are green. We can't take this move up. But that is the price we pay for trading with precision. You have to wait for the market to come to you. If there's a big price move up and it doesn't meet our requirements, we just can't take it. Here's another. Here are the trades. You go up, retrace right back to support, and you've got one tick above. You've got a big move up. Retrace, engulfing candle, up you go long. This is a break and retest of the 50, of the modified 15, and down you go. We're always trading in the direction of background bias and in the direction of our trading chart. Our trading chart tells us which way to go, and the confirmation on the higher time frames confirm that what we have is multi-time frame congruence, or all of these time frames align. And what's really great about what what bias does is it also makes an assessment of support and resistance. It looks at the 50, it looks at the 15, and it looks at market profile. So that you don't have to make, that's a very, very difficult assessment to make on 3 separate time frames. Your chart and 2 higher time frames. If you're trading into the 15 or the 50, you won't get background bias. Now, and trading during these clear periods is the most dangerous. It's not to say that you can't. What we want our software to do is to define risk for us. During a period where we do not have multi-time frame alignment, our risk for taking a trade is highest. When we do have multi-time frame alignment, our risk for trading is lowest. And that's really what we're looking for. Periods of time where multi-time frame alignment gives us the safest trades we can take. Now, just looking for another. See, this is a tradable setup. It's a break and retest of the 50 and a short right into background bias. The pink is the weakest, but it tells us that what we have is we've broken all resistance to the downside and we've got clear sailing. It gives us an indication of what's happening on the higher time frames. We have the same thing here. Break, retest, down, retracement, down, retracement, down. And we're not going to think about taking a long trade. Can't take this trade. Retracement to resistance and down. Retracement to resistance and down. And what makes the trades so powerful is this background color. It tells us that the 15 and the 50 and price are all moving to the downside in the 2 higher time frames, and in addition, that you've broken all resistance to the downside. Now that's the first indicator that I want to show you. The point is that we don't use indicators that assimilate data from our trading chart. We believe that does not, it's impossible for that indicator to provide us with any forward-looking data. So we have discarded that paradigm, so to speak, or that trading analysis. And that people are so dogmatic about it. If you look at software package after software package, everybody creates different names for these indicators, but if they assimilate information, if they assimilate price from the chart you're trading, they can't possibly predict what's going to happen to price out into the future. It's just not possible. So let's take these indicators off. And let me remove all the drawing. And show you the other indicator that we have. Now, one indicator looks at price on higher time frames. The other indicator, what I'm going to do on this, so I'm going to change the market to the E-mini. Now, and I'm going to change it to a 5 range. Okay, now, what we've developed are quant lines. And we have a quant line for each individual market. They're different for different markets. Now, what the quant lines do is instead of analyzing data from higher time frames, they analyze data from different markets. What we have done is we have found for the E-mini, for the Russell, for the Dow, and for the NASDAQ. We have 3 quant lines. Each line looks at 3 markets. So there's a total of 9 markets that are being assessed by these quant lines. And all of these markets, all 9 of them, correlate in direction with that of the ES greater than 0. With a correlation coefficient greater than 7.7 or 70% of the time. Now that means they either move in the same direction or in opposite directions. So in a way, you may look upon this as a complex analysis of money flow. Institutions are constantly rotating their money. When they see, when they perceive a lot of risk, they take their money out of equities and they move them into bonds and notes. When they perceive a lot of risk, they may move their money into precious metals. What this does is it's an assessment of market direction and those markets that correlate either directly or in an indirect or indirectly with that of the E-mini 70% of the time or greater. So what we look for is quant line confirmation of a move. Now we don't get 3 quant lines, red or green, very often, because that's the alignment of a lot of markets. But what we look for, the key quant line on the E-mini, are the first and the third lines. Now, if you want to trade them, we're going to teach you exactly how to do so. But you can see how choppy the market was today. Very little quant line alignment. Now right here, you have to remember that these lines are not even the E-mini. These are other markets. Now, if we've assessed them to move in the same direction, we get a green. You know, they will contribute a green. If it's the opposite, they'll contribute a green when the market moves up. When you get triple quant lines, you have a very, very high probability, or the predictive value of a long move is extremely strong. Now, I'm not saying that you use these as entry signals. You have to use the 15 and the 50, and you have to combine them with market structure and price action. But if you get a great entry and you want to confirm that entry, these lines are really remarkably helpful. And let me just put the 15 and the 50 back in. Now we have a whole suite of these lines for every single market. You can see here we have one for the 6E, for crude, for the E-mini, for gold, for the NASDAQ, for the Russell, for the Dow, for bonds, for notes. And we're in the process now of perfecting our quant lines for stocks. And that's really, I think, I mean, you know, you always hate to use the word revolutionary, but our quant lines for stocks are really going to be quite remarkable. But let me just put in the moving average again, and give it a 5, and the trend. And give it a 4. Now right here, what you have is a break and retest. And you can see that the 15 is green, the 50 is green, and if you look down, all 3 quant lines are green. And this gives you, at 936, a perfect long trade. Then when you get the retracement back to support, this is a multi-candle retracement. If you're a market structure fanatic and you're wondering whether to go long here, just look down at your quants. Triple quant lines. 9 markets are moving in the appropriate direction to tell you that this entry has a very high probability of being successful. Then you get another retracement. Now you look down at the quant lines. You still have triple greens. And up you go again. Now, price is not moving these quants. These quants are moving the price. Because this green is telling you that money is flowing into the E-mini and flowing out of markets that indirectly correlate with its direction. So they are very, very helpful. Now, if you trade without the quant lines, the trade is going to carry some additional risk. If you trade with them, the predictive value of your entry is much stronger. Now, here is a very risky trade. Whoops. It's a break of the 50 and a retest of the 50 with the 15 just crossing it. But you can see that the 50 is heading up, and that makes this trade very aggressive. What makes it less aggressive is you got the 15 cross 50, which we know is a really powerful signal. If you look down, 2 of the 3 quant lines are red. That's enough to tell you that the predictive value of going in short is extremely good. And again, these lines have no clue what's happening with price on your trading chart. That's why you can do a retrospective analysis of these and not get fooled like you are with stochastic and MACD when you look back and they're just driven by price on your chart. When price goes up, MACD goes up. When price goes up, the oscillator goes up. And it happens with everything. But this is not affected at all by price on the trading chart. Again, this is a break of the 50. Now, we need certain components to be present here in order to take this long on a break of the 50. It's an aggressive trade, but the quant lines really provide you with invaluable information on taking along. Now, if you want to wait for the first retracement, right back to support, which doesn't occur till all the way till here, you've got yourself a small winner. And unfortunately, this move back here, it actually is a trade. If you move up and you move back, what you have, if you're a little bit of a fib guy like I am, here's the move up on the triple quants. And you can take that on the yellow 15, and there's a gigantic move. So they really, really are helpful. So let's combine bias with the quants. multi-time frame analysis with multi-market analysis, all of which is totally unaffected by price on your trading chart. Okay, let me reload the chart. Ninja sometimes is very, there we go. Now we have multi-time frame analysis combined with multi-market analysis to help give us an idea of the positive predictive value of an entry at any given spot on this trading chart. All of the information here unaffected by the direction of movement, by the direction of price movement on the trading chart. And you can see how it really provides you with a real wallop when you combine the two. Now here you don't have bias. It's a more aggressive trade, but you got the quants. And when you have both, like you have here, and like you have here, these trades, I'm telling you, are gonna work for you 85 to 90% of the time or better. If you have the patience to wait for this kind of alignment, and you don't have, you develop the discipline to sit on your hands when you don't. And if you're willing to let moves go by that are sometimes large because they do not conform to your trading plan, then you can become a very successful trader just with these two indicators combined with a little bit of price action. You want to take a trade long off support and a trade short off resistance. And just take a look at this move here. Now this is pre-market, but there's nothing wrong with taking a pre-market E-mini trade. There's the move, and there's the retracement. You get a small move. There's the retracement. You get a really big move. There's the retracement. You get a huge move, all with a combination of an area where the downtrend correlates on 3 separate time frames, and multi-market analysis tells you that these correlative markets are pulling money out of this equity or out of this instrument, and they're moving it elsewhere. There's one entry, there's 2 entries, there's 3 entries. Now, if you have a big stop, we trade a reversal candle and we're out. But if you can take this move all the way to here, if you're willing to take that risk. It all depends on your risk tolerance. Now, your first entry can be right here. Now, I really didn't want this to be a discussion or a webinar about how to trade. What I really wanted to focus on here is simply to let you know that however you trade, whatever time frame you trade, whatever type of bar you trade, whatever your trading strategy is, these indicators are going to enhance that strategy remarkably. And that's really ultimately the bottom line for what I wanted to tell you. Now, I just want to say a couple of other things. Trading the quants, now you'll notice that we have multiple quant lines for different markets. We have a suite, 6E, crude, ES, gold, NASDAQ, Russell, Dow, bonds, notes. Now, we're in the process of perfecting this week our quant lines for stocks. One is going to be for stocks on the New York Stock Exchange. The other is going to be for stocks on the NASDAQ. We're going to stay away from stocks on the American, and we're also going to stay away from any stocks related to energy, just because they move in their own little world, and we are not that far away from building a set of quant lines that specifically deal with stocks in the energy sector. They are different, though. So essentially almost all stocks on the NYSE or stocks on the NASDAQ will be traded with two different sets of quant lines. Now, in addition, what we're going to do is basically offer these for purchase. Now, what we're going to do is, well, what I wanted to say first, before I even do this, is tell you that when you purchase them, or if you do, you're not going to understand how to trade them or trade them optimally, because you can see there are three quant lines. You have to know which are the major ones, which are the minor ones, and you have to look from market to market to market. Now, some markets, like, let me show you quickly, bonds. Now, bonds we trade on a 3 range. Now we have to change the quants. These are the quants for the E-mini. We're going to put in our bond quant. There's only 2, because we could only find 6 correlative markets. But you can see again how powerful the combination of the quant is with background bias. You wouldn't even consider trading a top or a bottom or trying to call a top when you've got 2 green quants and background bias green. And once you go into this kind of mode, you just look for that first retracement. Get close to support. Now, bonds, I believe, are 31.25 a tick. I mean, this is you know, $1,000 move if you trade a couple of contracts, and you have the precision and predictive value to do so when both quant lines and background bias align. There's the downside. Here, on this particular candle, both quant lines are red, and down she goes. Now, you can see that the top line quickly turned yellow, but you're already in the trade. And look at this retracement, and down. This retracement, and down at $32 a tick. That's a lot of money. And we get this on market after market after market. Again, you simply have to wait for the alignment of time frames and correlative markets. Now, if you decide to use these in your trading, you're not going to understand how to trade them. So what I'm going to do is we're going to hold a webinar for those people who purchase. And I'm going to spend an hour with those people teaching you what is important and the significance of these 3 different colors that represent up and the 3 different colors that represent down. So you're going to be able to make a great risk assessment of whatever trading entry you use, on any system that you use, on any time frame, on whether it's tick time or Renko. We just enabled the system on Renko, and it's irrelevant what you use. But what I want to do is I don't want to give you a 20-page e-zine or a video. I want it to be interactive, so at the end, if you have any questions, you can ask me so that you absolutely understand the meaning of the dark pink, the light pink, and the other down color, which we don't see that often. Which I can't even find. Is here. I think it's tan. And the three blue up colors, this magenta or cyan, green, and light blue. Now, they all have separate risk assessments, and you have to really understand clearly what they mean. And I'm going to explain that all if you're interested in the indicators. Now, normally, each indicator, if you look at the website, they're $599 a piece because they are really remarkable indicators. But for what we've done for the website, for the webinar, is they're $300 each. And if you want them both, they're $599. And Rory should put those links in. Now, for all the people that do purchase and would like them, now we've had a lot of people pay $599 for one. So basically, you pay $599 for both or $300 for one of them. For all the people that do purchase, we're going to very shortly announce a webinar time where we'll invite each of you in, and we're going to have a 1-hour interactive session where I'm going to teach you really the ins and outs of trading the quant lines and of trading background bias. It's a little bit of a, it's a real science, and I want you to understand exactly what everything means. And like I said, I don't want to do it in a printout that you download from your computer or on a video. And let me tell you, that would make it a lot easier on me. But I want all the traders who do come aboard to really benefit tremendously from these indicators. And I'm telling you, you will. Now let me just go and see if there are any questions. Hold on a second. Let me drag this over here. Okay, hang on one sec, and I'll read the question. Okay. Okay. Thank you, Noah. I'm talking, Payman. Brad says light pink versus darker pink. Please explain. The difference between the dark pink is that the market is trending. Both the 15 and the 50 on both higher time frames are heading down, and all resistance to support to the downside is broken with the dark pink. With the light pink, the 15 is not trending down. You really are not in a strong downtrend. What the light pink is telling you is that price is below all support. Now, once price breaks below support of the 50, the 15, and market profile, then clearly your bias has got to be to the downside. But this is the weakest color we have, because although you're in a clear-cut downtrend, the 15 can be flat. So you're not trending hard to the downside. It gives you useful information. You can take a nice trade on a light pink color, but it's not nearly as strong as the dark pink because you don't have the trend. You simply have broken all support to the downside. 50 period, Gordon. Gordon asked me if I mean 50 day or 50 period. It's 50 period. James, the bias indicator looks at 2 higher time frames. So on a 3 range bonds, it's looking at the 5 range and the 8. It always jumps 2 fibs. If you're trading time, it just takes 3 times. If you're trading a 1 minute, it takes you 3 minute and a 9 minute. If you're trading ticks, it takes the number of the 2 higher fib numbers on your ticks. If you're trading in between, say, 2 fibs, it's going to round down and then take the 2 higher fibs. Let's say you don't want to trade a fib. You want to trade a 450 tick. Well, what it's going to do is going to take the 450 down to 377 and then give you the two higher fibs off of that. Bias works on minute charts, James. It works on any time frame, any type of chart. It definitely works on minute charts. Manny, I just like range charts, range bars. I just really like them. It's just my own style. Michael, these are our indicators. Michael asks where these indicators thinkorswim. These are on NinjaTrader. We also have them now on Sierra charts. So if you have Sierra charts or if you have NinjaTrader, they will work for you. We're not on thinkorswim. For instruments that are inversely correlated, correct, Fitzroy. If we know that every time that bonds go down, another market goes up, that's going to create a down color. Because what it is, when that market goes up, it predicts that bonds fall. So it's going to give us a red color. We know whether the market is directly correlated or indirectly correlated as long as it moves in its appropriate direction 70% of the time or greater. Correct. It is being recorded, Jack. Jack, I'm sorry. Fitzroy, you're absolutely correct. All of Fitzroy says, aren't all the equity instruments correlated with each other? So in effect, they are not really independently correlated. Correct. They are correlated with each other. But here's the thing. Some are loosely correlated and some are tightly correlated. What we wanted to do was tease out which markets. We set a correlation coefficient of 0.7 that wasn't arbitrarily set. For papers, scientific papers, you look for a p-value of 0.2 or a 0.02 or greater. In other words, what we're looking for is, I don't want to get too complicated about things occurring as a chance random event, but what we're looking for are markets that are tightly correlated, not loosely correlated. Because if they're loosely correlated, we're not going to get the appropriate colors enough of the time. So we're looking at tightly correlated markets. But you're correct. I mean, all these markets have a network to them because you have to look at it as there's a fixed amount of money. I mean, I wouldn't even hazard a guess as to how much it is, but it's simply being rotated around from cash, and we do have the dollar in this analysis, from cash to precious metals to agriculturals like wheat, soybeans. They're just rotated from sector to sector, depending upon what the big institutions perceive are going to provide them with the most return on their money. Now we get an idea, we get a window into looking at what they're doing by looking at these correlative markets. There's no way we could do this analysis by hand. Absolutely, Scott. If you paid $5.99 for the quants, we'll send you the bias. We're just not interested in doing that to you. Not a problem. You just send us an email, and we'll send them to you. They are Bloodhound compatible, Adam. And the webinar will be recorded. Resistance is futile for dark pink. You got it. It's all broken. On a range chart, as I said, we use the fibs. So on a 3 range, the 2-hour time frames are a 5 and an 8. If you're trading an 8 range, we use a 13 and a 21. It's the same thing that we do for ticks. If you're trading a tick chart and you're trading, say, a 144 tick, which is fast, the 2-hour time frames are the next highest, 2 highest fib numbers. If you want the 15 and the 50, add it in, James, and you buy the combination, we'll give them to you. We'll give you the 15 and we'll give you the 50. Now, I want you to know right off the bat that the 50 is nothing special about it. It is just a 50-period moving average. The only thing that's special about it is the color. And we spent a lot of time on it. And the line slope is really, really well done in terms of slope degree. And when the market is really flat, the yellow color does help. If you buy one indicator and you'd like them, just give us a call and we'll talk to you about it. But if you buy both, we will give you the 15 and the 50. We won't even charge you for them. Okay, just hold on 1 second, James. How much to get those? The 15 is flat on the trading time frame. Well, Alan, we only like to trade the market when the 15 is trending on our trading chart. We're only going to get background bias, certain background bias colors when the 15 is trending. That's what I'm going to show you if you get the indicators. In that webinar, what we're going to do is I'm going to put up all 3 time frames, and I'm going to show you how exactly what they represent. And we're going to go through it. We're going to spend a lot of time on it. And the thing that you can't know without my telling you is when you have multiple quant lines, which are the majors and which are the minors? Which do you really want with you, and which line, you know, if it's yellow and the other 2 are red, it's still a great trade. If you've got that quant line with you, it's even better, but it isn't necessary. And because there is one key quant line that you'll always want with you to take a trade. And I'll tell you right now, it's the bottom quant line in any suite. You really want that bottom quant with you. Those are the key markets, the most important. And when you trade, you can still take a trade without it. All we're doing is defining risk. But if you don't have it with you, you're simply trading with enhanced risk. That's all. No software package can do more for a trader than define risk for you. No blue dot long or red dot short system will ever work because they don't have a sensitivity, a specificity, a positive and negative predictive value. These indicators do. And what they're trying to do is bring that positive predictive value up really high and the negative predictive value down really low. So to give you every advantage you can when you trade. And you really do, because you can't beat the institutional guys. They're the ones that are setting the quant lines. They're the ones that are creating the trend in the correlative markets. We want to trade with the quants. We want to trade with this money flow is the big institutional money flow. And we want to trade in the direction of the trend on 3 separate time frames, because also institutions create the trend. God forbid for us, we should take a long trade on a pink color or a short trade on green. I mean, in all likelihood, if you win that trade, good luck. But it's suicidal to do that, because in all likelihood, the market's going to go up. Correct, Larry. That is correct. For all symbols and the indicators, and when we say quant lines, we mean every single line we have. It's the whole suite. Yes, the lines are included in the 599, James. We will include them. Sierra, we're good to go on. Yes, on the light pink, the 15 is flat on your higher time frames. Now your 50's down, but your 15 is flat. Price is below both areas on a short and above both on a long, but you have to be cautious on the light pink and on the light blue, on this blue, because in these markets, you're either above resistance or below support, but you don't have a trending market. Well, you know what, Fitzroy? We have so many correlative markets. And listen, we're not looking for 100%. I mean, Fitzroy asked what happens when the correlation changes. And correlation does change from time to time. We always tweak and upgrade, and we are always looking. And if you ask people who have our system, we constantly send out upgrades. Now, if one market has a correlation coefficient that falls below 70, or one market comes back up above 70, we are going to rotate one out and rotate one in. Right now, we're doing the same analysis over again that we've already done probably 30 times for stocks. So we're doing a complete review of all of our quants and all of our correlative markets, futures, everything, in order to create our stock quant lines for NASDAQ and NYSE stocks. Correct, James. It's also telling you that whether you've broken support and resistance on the 1550 and market profile. They are bloodline, Bob. They are bloodhound compatible. We can use it on minute, any time frame. Correct. Bias will calculate by itself, payment. If you trade a 3-minute, bias will do your higher time frame. Your first higher time frame is 9. Your second higher time frame is 27 minutes, automatically. Scott, HTFs, I'm not sure what you mean by that for Renko charts. Oh, the higher time frames, same thing. If you're trading a 3 Renko, it's going to go to the 2 higher fibs, and if you're trading it in between, it will round to the closest fib, and then from there, take it to the 2 higher fib numbers. What are the start and end times of chart time? I'm not sure what that means, Gordon. Thank you, Scott. I just wondered what Scott said. I've been using the quants for 6 weeks. I won't trade without them. A truly premier indicator. Thank you, Scott. Scott, you let me know, and I'll put you in the room. Okay? Not a problem. Alan, we go back 1 year. Okay? Oh, session start and session end for crude. For crude, it's 8 a.m. in the morning until 3 o'clock in the afternoon. And for all the index, for all the others, it's market open to market close. 9:30 a.m., 4 p.m. close Eastern time. And listen, I got to go because everybody in my office wants to leave. This is recorded. Rory should have put the payment links in there if you want to come aboard. I think these indicators will definitely be of benefit to you. If you buy both, you will get the 15 and the 50. They're extremely helpful. This 15 is a proprietary line. It's built to be stable. So let price chop around it. But when it trends, it's really significant. Compatible with Infinity? I don't know, James. The only thing I know for sure is we're compatible with Sierra and we're compatible with Ninja. I don't know about Infinity. I really don't. Oh, if it's Sierra charts, then you're good. We're good. We're good on Sierra and on Ninja. All right, listen, everyone. Thank you so much. If you have any questions, we'll be in the office another half hour. I really appreciate it. And whatever you do, I really wish you the best of luck. And I hope you guys make money. And I really want you to become real profitable traders. So everyone have a great, great evening. And thank you very much again. And feel free to call us, ask any questions that you like. Take care and have a great evening. Bye-bye.